6 years after the great financial crisis, the economy remains fragile. The U.S. recovery continues at a subpar pace, Europe has slowed to a crawl, and growth in emerging markets, including China, has tailed off. Michael Hood, market strategist at J.P. Morgan Asset Management and contributor to Institutional Investors' Global Market Thought Leaders series, shares his views on the global outlook.
I think that the U.S. economy is likely to perform better from here than it has up to now in the expansion. It's true that this has been a disappointing recovery from what was a very deep recession. There have been a lot of things that have been sitting on U.S. growth during the past few years, including very tight fiscal policy and very tight bank lending standards. And we've gone through inflection points in both of those areas. Private sector balance sheets are in good shape, and without those obstacles to growth operating as strongly as they have up to now, I think we'll see at least a mild acceleration in growth from here. There's certainly been a disconnect between the performance of equity markets and fixed income markets this year. Equity markets have been acting like the weak growth data in the U.S. is temporary and perhaps wrong, and fixed income markets appear to have been taking it very seriously indeed. I think some of what's going on relates to the international environment, where we've seen increased dovishness from the European Central Bank, as well as continued all-out bond purchases by the Bank of Japan. And those have exercised a gravitational downward pull on yields globally. I think that what we're likely to see as global monetary policies increasingly diverge is increased volatility and perhaps some new trends in foreign exchange markets in particular. With every central bank in the world essentially pushing in the same direction over the last years, there's been very little change in and very little level of interest rate differential. And it's really shorter-term interest rate differentials that tend to be the most powerful drivers of currencies. So as we see the Fed and probably the Bank of England move into monetary tightening cycles, we'll see short-term interest rates in those economies start to move up, whereas they'll be flat to perhaps even down in other jurisdictions like the euro area. I think that's likely to provide support for the dollar and perhaps for UK sterling over the course of the next year or two, probably starting as we get very close to the actual timing of the first Fed hike in the middle of next year. The dollar's been flat, more or less, for the last few years, and people have wondered about that because the U.S. economy has been the best performer. But I think the answer to that puzzle lies in the fact that the Fed has been very successful at anchoring short-term interest rates. As we move away from that anchor and U.S. yields start to rise, particularly in the short end, I think that that's when we'll see the upward pressure on the dollar start to develop. My outlook for the U.S. economy is one where, because of my view that we're still in the middle stages of the business cycle, the risks in that stage, in that phase of the expansion, actually tend to be fairly low, which is why low levels of market volatility at the moment don't concern me much. I think the biggest risk to my outlook is not a kind of tinkering around the edges, euro area might be weaker than I think, or something like that. I think the biggest risk is perhaps that the U.S. economy isn't in that part of the business cycle at all, that it's instead in the later stages, that there's less spare capacity in the system, particularly in the U.S. labor market, than I believe to be the case, and that indeed recession risk is closer. Because recession is the one event that changes everything. It doesn't affect your outlook at the margin, it affects every aspect of your portfolio.